Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug. I'm president of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can listen to all of our podcasts at americastalking.com. We are recording today's episode on Thursday, June 15th. And joining me, as always, my friend, my colleague, Dr. Orphe Divounguy. He's a PhD economist. Dr. O, always great to be with you. We're going to go right into, we talked about what was coming up. The CPI was going to be released. That came in about as expected. And the Federal Reserve came forward and offered its thoughts for June. And that also came out as we had expected. And I think as many also expected, there was no change to the rate. So what do you think?
So, yeah, it's very difficult. And again, the Fed's job, again, very, very difficult to do what they do. And so I'm not even going to pretend that I could ever do the job. But here's what I see. What I see is a ton of disinflation since last June. That's good news. However, core inflation remains elevated, well above the Fed's 2% target. And we could have a whole debate about whether or not the 2% target is the right thing or if it should move or whatever. The 2% long run average target is still what it is. And Fed Chair Powell said we need to get back to that, right? And then they paused. They paused and then suggested that they may have to hike again before the end of the year, twice before the end of the year. And so a great question that I heard from a reporter from the Wall Street Journal was, why pause now if you're going to have to hike again later, right? And so I think what I heard from Jay Powell was, and he even slipped out the word skip at some point during the press conference, is that they're going to hike for sure. It's not going to be maybe we'll hike. It's we're going to hike. What brings me to that conclusion? Well, there's not going to be a ton of economic data coming between now and the next meeting, and so what's going to sway the Fed in one direction or another, other than what we already know, which is basically core inflation is still too high and the risk is still on the upside. And so those factors, in my opinion, those factors are almost guaranteeing us another rate hike. And so, Jay Powell kind of danced around the idea that maybe we need to separate the pace of rate increases from the level. And he said, look, the pace was really rapid. We had to play catch up in the past year and we paused because we want to slow the pace of rate increases. But that doesn't mean we're done. And, I think about this and I say, okay, well, that makes a little bit of sense, right? A plane is getting closer to the runway. It slows down on approach to land the plane softly, right? And for a soft landing kind of makes sense. But in my opinion, the pause brings up other risks. If core inflation is actually accelerating and not decelerating in the last 3 to 6 months, then could it be possible that by July, by the next meeting, core inflation has actually gone up instead of gone down? That's very possible. Now, of course, the Fed chair brings into appeal to the fact that goods disinflation is still happening and the goods sector is in contraction territory. He appealed to the fact that housing inflation has come down tremendously and is likely soon to be reflected in the consumer price index. And then he also said, look, core non-housing services are also showing early signs of disinflation. But he did also say, that particular sector of the economy was the part of the economy where the Fed had seen the least progress against fighting inflation. We know that sector has been kind of stubborn. There's still a ton of missing jobs in healthcare, lots of supply chain issues, labor shortages, in healthcare services that you can, leisure and hospitality. There's a big gap still in where we are today compared to where we were before the pandemic began. And so, in my opinion, there's risk there that we're not going to continue to see a ton of disinflation in core non-housing services unless the Fed continues to apply the brakes, and so that's my thought. And of course, we know the Fed will apply the brakes, but hopefully it can stay ahead of the curve rather than start to fall behind again by kind of pausing now, and then punishing us later.
I'll tell you, this is purely anecdotal, but I like to live my life out in the world, right? And, part of what I do is I grocery shop, every weekend. And frankly, even when I'm on the road, and I've been on the road quite a bit, I try to just live a normal life and not eat at restaurants all the time, stay in places where I have access to cooking equipment and, little kitchenettes and whatnot, and go grocery shopping. And I've done that the last 3 weekends in places outside of where I live, Colorado and most recently Pennsylvania. So what I'm hearing from the people in line around me is still a certain amount of upset. That the cost of things, and the looks on people's faces as their totals come up, it's painful to watch. I think middle America and, people that are living sort of on the kind of the lower bar of the middle class are really feeling it. In particular, at the gas pump back in Illinois, $4.49 a gallon for 87 regular. And at the checkout line at the grocery store, you don't have to be a genius to connect the dots between the price of fuel and the cost of your groceries, because they don't grow in the back of the store. What do you think? About that segmentation? And is there any, I'm not asking you to provide some level of false hope.
Look, prices are not coming down, right? They're increasing at a slower pace. We did see some decrease in gasoline prices in May, which was, welcome relief. But then OPEC's going to cut production, right, to try to offset some of the decrease in oil prices, global oil prices. And so they're going to do that. And so because, you're seeing a slowdown in energy, food at home is up 5.8% year over year. Prices for food at home up 5.8% year over year. That's your groceries and all that. So very, very high, very high. Food away from home is even up higher, right? So that's your restaurants, right? 8.3% year over year. And again, that very much reflects the fact that you have labor shortages in that sector. That means costs have gone up. And some of those costs are passed on to consumers in those industries, which is why, a lot of economists worry about labor cost, unit labor cost. And they say, look, labor cost growth might be a problem. In fact, Fed Chair Powell referred to that during his press conference. Core non-housing services are labor intensive sector. And we're talking about some of these, other transportation services, medical care services, labor intensive, as long as wage growth in that sector, that we face these labor shortages, and that labor cost is so high, labor cost growth is so high, we might continue to see this inflation, this pressure on prices. And so, yes, it's painful. It's really still very painful, especially for lower income families. I think the Fed recognizes this, right? They say this is why it's so important to bring inflation down, which is, why I kind of question a little bit and by the way, I'm I'm not one of those hawkish commentators. I think that the Fed should really deal with the inflation problem. And when it's time to cut, I think I'll be the first one to say it's time to cut. But we still have an inflation problem. And I think the risk is for us is greater from not squashing inflation once and for all, putting the nail in the coffin, right, than it is from job loss. You're looking at the labor market. Labor market is still very strong. You're getting a little uptick in the unemployment claims this week and last week and this week. But the labor market is still pretty good, broadly speaking. And so the risk is on the inflation side, not on the labor market side. I don't think we should be concerned necessarily about big job loss yet. I think we should still be very much concerned about prices and core inflation not coming down sufficiently to justify stepping off the economic brakes. That's my take on this. I think I work in housing. And so everybody's always like, what's going on with mortgage rates? Look, mortgage rates are going to stay high as long as inflation remains as high as it is. Once we get inflation under control, we'll be able to start to see mortgage rates decline. And when mortgage rates decline, we'll see housing demand pick up. We'll see even housing supply, existing homeowners that had been left on the sidelines because they didn't want to trade in a low mortgage rate for a higher one. Those people are going to start to come back. And that's going to be very beneficial for home sales. So it's in our best interest that the Fed does not make another mistake and that the Fed focuses on bringing down inflation. I don't know if the pause is going to do that necessarily And I understand the arguments. I understand that, there's the credit tightening that's supposed to cool the economy further. I get that, but we're not quite seeing that enough yet, right? Because core inflation remains somewhat stubborn.
Yeah. Well, I appreciate your thoughts as always. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics at americastalking.com.